Welcome back, everyone. Today we're going to be shedding light on why most companies do not fill market gaps. So why do most companies desist, abstain, and refrain from filling market gaps? Why are most companies reticent and recalcitrant about filling market gaps? Why are they reluctant and disinclined to do so? Without further ado, without further delay, allow me to demystify that answer to that inquiry right here, right now. Filling market gaps can be a cost-prohibitive undertaking for companies and entrepreneurs to undergo. However, that is not the main deterrent to fill market gaps. When you fill market gaps, you are making an earnest, valiant attempt to assuage unmet customer needs in an untapped market. Companies cannot extrapolate sales forecasts with sheer and utter accuracy if they are churning out innovative products for a new target market that is subsumed under an untapped market. Companies want to always be able to reap a positive return on investment post furnishing products to a target market. If they are filling market gaps, they cannot accurately nor predictably forecast product sales. If they are developing new products for a new target market subsumed under an untapped market in an earnest attempt to fill a market gap. They'd rather play it safe. They'd rather assuage customer demands in an existing behemoth of a market that they already compete in lieu of filling market gaps by entering into an untapped market. Research and development costs can be exorbitant. Production costs can be exorbitant. And marketing costs can be exorbitant. Because these aforementioned costs are so steep, hefty, sizable, and lofty, companies need to be able to accurately forecast product sales. They cannot accurately nor predictably extrapolate future product sales if they are servicing customers subsumed under an untapped market. There's no basis for being able to accurately and predictably forecast future product sales if they are competing in an untapped market in which there is no historical sales data to reference. So, companies do not fill market gaps because doing so can potentially yield a negative return on investment. Doing so is ineffably risky. And doing so can cause them to shift away their focus from servicing their existing customer base. Business operations become all the more complex, all the more convoluted, all the more multifaceted if the company is dabbling into competing in these untapped markets and is making an earnest, valiant attempt to service customers subsumed under these untapped markets, especially when they are not guaranteed to reap a positive return on investment by doing so. It's easier to service an existing customer base. It's easier to compete in existing markets with enormous customer bases than it is to gamble with your capital and hope that developing new, novel, innovative, creative, robust, meritorious, worthwhile, extraordinary products for a target market that is subsumed under that is subsumed under an untapped market. So companies would rather play it safe, and they want to have the highest probability to reap a positive return on investment. When you fill market gaps, you are gambling with your research and development dollars, and you're taking a strategic risk that may not pan out to yield a positive return on investment. On the other hand, when you try to appease your existing loyal, stalwart customer base by investing in producing negligibly nuanced versions of your existing products, it yields lower research and development costs, it yields lower marketing costs, and you can more accurately and predictably forecast future product sales, which can allow you to have a higher probability to yield a positive return on investment. So companies are disinclined to fill market gaps because the risks are huge, especially when they already have enormous customer bases that they know they can milk if they were to just release negligibly improved versions of their existing products. I hope that you found this video to be enthralling and insightful. Have a blissful day. Goodbye.